Hi, this is our Forex blog for May 8th, 2012. And like most days, we want to buy the strongest currencies versus the weak and sell the weakest versus the strong. We have the real-time trend on the top, which is made up of multiple different statistical tools averaged together. 3 of the 5 measure the direction that the dollar's moving versus the rest, and the other 2 measure intensity of direction. So anytime you have incredible intensity at and above the 80 level, and then a pullback with less weakness or less amount of time for the pullback, you can see strength, very little weakness, not much strength, even less weakness, strength, no weakness. Obviously, that's a trend that's likely to continue. Everyone knows to trade with the trend. But what trend? This is a real-time trend. This is the percentage of currencies trending up or down on the 15-minute trend, hourly trend, then we have daily, weekly, monthly. So the more time frames that line up, the higher your chances of winning and the more odds of catching a bigger move. If some of the trends are going up and some are down, look for 5 to 25 pip wins. If the majority of the trends are up and with incredible intensity, then look for 20 to 50 pip moves. You can see the dollar and the yen are both strong. The weakest ones are the Australian, New Zealand, the CAD for part of the time, although the weekly, monthly trend were slightly up earlier. The weekly trend, daily, 15 and hourly all shifted down, so you could have also traded the weak CAD against the dollar and the yen. But the New Zealand and Australian clearly are the highest probability. So you want to sell the Australian dollar. Here is a range bar chart of that, and you can see it goes down, pullback trade, down, sideways, down. Couldn't be easier on days like this. I'm working on automated systems that use range bars, chart patterns, and trends, and got a lot more work to do, but let me just put this on the chart so you can kind of see the kind of patterns that you should be looking for yourself. Range bar, 3-bar buy, sell. Anytime you see a trend that's down followed by 3 to 5 bar up movement, when you get that first red bar, you want to sell. So you can see that signal right here, generated a nice move down. We got a sell signal right here. You wait for it to go below that bar's low, and you would have been stopped out with a small loss. You go short again right here at 50, and you can see our trailing stop got you out at 29. So if you lost 10 pips and then made 21 pips in this first trade, you're short here at 90, and you got out all the way down here at 35. So you can see you made quite a bit of money. And this trade right here also is another signal, and that led to a nice 50 pip move as well. Let's take a look at the New Zealand dollar as well. Since the New Zealand was super weak, the dollar is strong. Now this is a 5-minute chart instead of a range chart, but you can still get the same idea. When you see a trend like this, you wait for a pullback. You can use our intelligent trailing stops to go short at 33. Got you out here at 89. Notice how the intelligent trailing stop kept you in for the entire move versus maybe you only get back 8 or 9 pips max. It's one of the most intelligent trailing stops that retail traders have. You go short again, right? If you went short right here, you have a 10 pip loss. Short again right here. Maybe you got your 10 pips back. Short here at 90. And got you out right here at 71. And when it's underneath the lower containment band, it's much more likely to reverse back up. So let's look at the Australian yen and Australian dollar. You can see this one, same thing. When it's underneath the hourly, sell, sell, sell. And I'm going to bring up a range chart of this so we can compare that. Okay, so here's a range bar chart, and I personally think they're so much clearer than regular 5-minute charts. Here's the 5-minute chart. You can see, obviously, a very nice move down, pullback, small profit, pullback, pullback. It made 3 little mini waves up. Let's go and look at the range bar chart, and let's put the signals on here. There's really 2 main patterns you're looking for in range chart. Now this is for educational purposes only now, but whenever I have the auto systems done and I also trade with it with my own account for a while, I'll display it. But you can see when I add that to the chart, you got a nice little pullback right here, led to a profitable trade. This trade right here, it pulled back enough that you move your stop down a little bit. You would have lost 6 or 7 pips on that. This trade right here led to a profitable trade. And once the market really starts moving down an incredible amount, it's underneath the lower containment bands, it's much more likely to reverse. So you might not want to be taking trades down here. And if you do, once the market's moved a lot of pips, if you do take a trade like this and it starts going down, wicks are oftentimes reversal signals. You can see right here, right here, right here, right here. right here, right here. Wicks on that are going up are very good patterns for trends reversing. You can see wicks on the top here, down, wicks up. This one didn't pull back that much. But the point is, when you see a currency that's down a lot and some wicks at the bottom, very high probability reversal. And especially earlier on, when you took these earlier trades, you can draw your fibs on this. And it's a great place to get out at the fib target. After this currency made one wave down, a big move down, and then this is the third wave down. Usually after 3 or 4 waves, the trend is over. So if you are looking to sell right here, keep in mind that the 1.382 fib target, the half number, very high probability likely end of this move. Also, looking back on the 5-minute chart, which has all of our indicators on it, let me bring the Australian yen back up. You can see it's underneath the lower containment bands. This tends to be an area where the market reverses at. So if you did look to sell those areas right there, which you saw on our range chart, you had a 20 pip potential profit, whereas earlier you had a much higher probability trade that also was much more likely to give you 50 pips. Definitely making the trade worth taking. So last but not least, the weak New Zealand versus the super strong yen. We're going to bring this chart up on a range chart. And, once this thing starts trending, you always want to draw your fibs on there. I like to sell the 38 to 50%. I prefer the 50% pullback area. A lot of times when currencies are so weak, they won't even make it to the 50%. But you can see these signals here are right near the bottom. A lot of times the end of trends are, double tops, double bottoms. So if you did sell right here when it went 1 pip underneath the low here at 63, your potential profit tower gets only 10 pips away. Are you really going to risk 10 pips of your hard-earned money and your family's money with the chance, whether it's slim or even high, of only making 10 pips? It's not quite really worth the risk. So I would wait for this move right here. You sell that one. And anytime the currency starts moving your way, 5 to 8 pips, I tend to move my stop down. At my initial risk is 6 pips, this is a 6 pips per bar range chart. And once it starts moving my way, I'm moving my stop down a little bit, sometimes over that previous bar's high right here. And so now my risk is not the entire amount. If the trade's going to work, usually that's good enough. This is my newfound risk right now. And you can see again a wick at the bottom, which is not really good. If this thing came up and was kind of going sideways right here and went down again, I'd watch it like a hawk. A lot of times I'll take 3 to 8 pips off the first half just so I can lock in some profit. Because markets trend and then they're oftentimes choppy. And if you're in one of those choppy phases, it's better to take 3 to 8 pips than a loss, certainly. But even if you did lose 5, 6, 7 pips right here on this next move up, another counter trend signal. Remember, 3 bars in a row followed by 1 back in the direction of the trend. You sell it when it goes 1 pip underneath the low. Now, notice the difference between this trade and the previous one. This is probably a trade I would have taken. I would not have taken this one because it's too close to the low. And in this particular case, the market just fell, kind of went sideways, fell again. It wasn't kind of a gradual move down. I don't like to sell 10 pips away from possible support areas. I like at least a 15 pip pullback. This one did move up 15 pips, but by the time you sell it right here, you're getting into it 10 pips away from the low. These don't come up until after the bar has formed, too. So you don't know until that bar is over what the signal is. And that's just based on how this range bar, 3-bar method works. Anyway, this trade right here comes down, it's kind of chopping around. You get out of half, you move your stop down above the bar's highs right here. And typically, you're not going to get greedy. You're going to draw your fibs on that. And then when it comes down to the fib target, you're out at 85. So I would have got out of half probably at around 63.02, the other half at 85. Let's just say the average exit's 95. We're short right here at around 18. You made 22 pips while risking, less than 10. And that's really the key to trading. Small losses, big wins. I'll say that again. So many traders think, and I've shown, these signals to people, and they say, well, there's some losing trades. Well, no shit, there's some losing trades. I mean, nothing pisses me off more than pure stupidity. There's no trading system you will ever find or has ever existed nor will ever exist that never has a losing trade. If you can't take losses, you have no business trading. You're not a professional. You're a pure amateur. Take trades that are high probability and have a good chance of giving you 2 times more profit than what your risk is. In other words, avoid trades that are right near the lows, unless the market kind of goes down here and goes sideways for half an hour to 2 hours and doesn't even move up at all. Then when it breaks down, it's very likely to work. That's a trade that has a very high probability. But other than that, wait for a decent pullback, primarily to 38% fib, and then see how it goes. A lot of times the markets just keep going down, down, down like this. There's a lot of different ways of exiting your trades. You can just simply put a stop right over your high. Let's say you got short somewhere in here. Keep moving your stop down above the bar's highs. And, at this point, you would expect some kind of a pullback. So don't be greedy. Draw your fibs on there. And I probably would have got out at 01 and not got that last, 7 pips. Don't be greedy. Get out at high probability levels. Most of the time you're going to catch, a third to 70% maximum of any given swing. And that's good. You should be happy with that. You're never going to catch every pip. Don't be greedy. Try to, catch as many pips as you can during the day while avoiding losses or minimizing them. You can't avoid them completely, but you can certainly avoid stupid trades like selling right near the lows.